Hey, good afternoon or good morning, depending on where you are. Thank you for joining us for today's webinar, where we'll talk about stress testing. My name's Sean O'Brien, president of QwickRate. And as always, I'm pleased to be joined by first Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, thanks, Sean. Thanks, everyone, for joining us today. My name is Steve Huntington. I'm the Director of Analytics here at QwickRate and QwickAnalytics, and I've spent my entire career working with community financial institutions all across the country, and more than half of that has been here at QwickRate now.
Awesome. Thank you, Steve. To talk about the loan level stress testing aspect of our today's presentation is David Ruffin. David heads up our IntelliCredit division. David, you want to go ahead and introduce yourself?
Yes, thank you very much, Sean and Steve. Always a pleasure joining with you, and we're delighted now to be able to say we can complement the robust portfolio level stressing that our sister division, QwickAnalytics, can do. So look forward to pairing this in that sense.
Great. Thank you, David. Just a reminder, again, QwickRate does a number of different things. Most of you on the call today are aware of it, but just QwickRate, IntelliCredit, and QwickAnalytics are three different products and services that we offer. Just a reminder, we actually had a question in the chat. We will, you can certainly use the chat and Q&A box to interact with us today. We will send out a link to the recording today and a copy of the slides in an email that we'll follow up with. But certainly during the discussion today, go ahead and use that Q&A box and chat. We'll either take the questions as they come at an appropriate break in time, or we'll take them at the end of the discussion. Again, I think we're just going to talk a little bit about stress testing. I think for a lot of people, it can bring up some confusion or even maybe just a conundrum of, what's the best way to approach stress testing. So we're going to talk today about two of our options that we have available. Again, hopefully offer some insights on how to, maybe optimize or improve what you're currently doing. So I think, the conundrum for most individuals or banks really comes for, what to do about stress testing and the expectations around it. Really, we had a renewed emphasis on stress testing coming out of the great, the financial crisis of the Great Recession, particularly by the OCC, who really wanted banks to, and boards in particular, to understand what their level of capital cushion really was. And if we were to experience downturns again, how much in losses could a bank absorb before they would need to start to, either breach a well-capitalized level, or just start to need to think about seeking out additional capital. And so, that was really kind of where we started with ours at the portfolio level. But I think, this time around, everything's always different. Interest in, particularly stressing areas of most vulnerability, which today is commercial real estate and the subsets that might make up the commercial real estate portfolio. And so, for some banks, that type of, more focused on an individual loan level basis is perhaps more appealing. So there's no right or wrong answer, but there are a number of different ways to kind of go about tackling this, right? And so, I think that lack of regulatory prescription and the different approaches and just what stress testing kind of conjures up, does make it at times a little bit confusing on what's expected and where they would like to see banks move. We think, again, part of this is really anything is going to be a step in the right direction. Anything that you do is going to be seen as taking a proactive step, which will be, usually typically, applauded and well received. And I think, we really fundamentally, urge banks to just make this part of your ongoing risk management, and overall risk management. Again, coming out of the financial crisis, a focus on enterprise risk management, really began to take hold. And I think stress testing is really a pillar or a foundational piece of that type of testing. Okay, so again, as we touched on, there's a number of different things that conjure up when we talk about stress testing. These are just some of the, the sources or areas that can potentially confuse. I think really everything starts with the data. I think we take that approach both in QwickAnalytics and IntelliCredit. We are really focused on aggregating data for you so you can either analyze it or we can assist you in analyzing it. Again, whether that's done at the portfolio level, utilizing call report information or utilizing loan level information, that you can provide to us that we can then ingest into a tool or a service. Really everything starts with the data. So again, no right or wrong way to do it. Obviously, the more granular you get, the more options you might, have. So we're going to talk first about portfolio level stress testing. Again, we utilize call report information in QwickAnalytics and have built a portfolio level test at that level. And Steve, if you want to go ahead and talk a little bit about our test and how we get started with it.
Sure. So when you run a portfolio-based credit stress test using our tool, our automated tool, there's 3 completely separate and independent tests that we run. The first test is what we call the peer group loss experience, and that is where we're aggregating your peers' loss experience at the segment level. So with as much granularity as we can get with the publicly available call reports, and looking at their loss patterns at the segment level throughout different economic times in the past. So during a healthy recent environment, like the last few years or almost the last decade at this point, and also the most recent stress period, like the Great Recession. And the Great Recession, that last industry stress period can be either defined by default or you can go in and customize that. But once we aggregate all of your peers' historical loss experience, we apply it to your loan portfolio going forward. So we take their loss rates and apply it to your current balances to make it applicable to your institution. And we're trying to answer the basic question: if your loan portfolio, with its size and its structure, if it were to perform like your peers did in various environments in the past, healthy, unhealthy, and worst case scenario, what would be the pro forma impact on your P&L and capital? So we are, in fact, completely reprojecting your earnings over a 2-year forward-looking time horizon, and also reprojecting all of your regulatory capital ratios as well. Now, the second test we run is what we call the bank historical loss experience, and it has all the same steps. They're designed to be pretty much set side by side because it has the same methodology, same steps, and same outputs. The difference is in the loss inputs. We're ignoring, in the second test, we're going to ignore your peers' experience, and we're going to focus on how you fared during a recent healthy environment and during the meat of the last credit cycle. And we're going to answer a similar question: if your loan portfolio were to perform like it did in various environments in the past, moving forward, what would be the pro forma impact on your earnings and your capital? And then finally, we run what they call a reverse stress test. It's what I fondly refer to as the "how much rope do we have to hang ourselves with" test. The regulators call it a reverse stress test because conceptually it really does work in reverse order. Instead of starting with reprojecting loan losses and then using that to reproject earnings and finally reproject capital, we start at a presupposed capital level or threshold, say the minimum to be well capitalized or adequately capitalized, those PCA thresholds, or just your own internal capital minimum target before it triggers some sort of board action or consideration of slowing growth, or even more significantly, a consideration of an additional capital raise. And we work in reverse order to figure out what levels of losses in your loan portfolio you could withstand or absorb before your capital were to get down to these critical PCA thresholds or internal thresholds. So if you go to the next slide, Sean. And in the first test, the peer-based test, and then the second test, the bank historical test, there's 3 basic steps. Once we have calculated the historical loss rates from your peers or from your own institution, we use that to re-estimate what loan portfolio losses in dollars might be on your current portfolio if it were to have loss rates as it did in the past. Then the second step, once we've recalculated and reprojected dollar amounts of loan losses, and keep in mind, it's not just about loan losses. We also have to keep track of reserve levels, and we have to keep track of losses on the sale of OREO, because during a recent environment, there hasn't been too much concern on valuations on real estate dropping before it can be sold off the books. That was a very large piece of the overall puzzle during the last credit cycle. So not only were there losses on the loan portfolio, there were losses on the sale of OREO, and we were all, as an industry, required to keep higher reserve levels. So we had that double whammy going on, right? Of not only having to have higher loan loss provisions on the income statement due to increasing charge-offs, but also additional provisions on top of that to get our reserve up to a higher level than it was during a healthier environment. Then the second step, the second step there is to reproject earnings under all three scenarios. So as you'll see in a minute, we run all three scenarios side by side. It's very, very clear and clean, and we color code each scenario so they're easy to track and follow. And then the final step, of course, is estimating the impact on capital levels and capital ratios in all of the scenarios side by side. So next slide. So what we're going to do here is I'm going to go through the next few slides. Oh, actually, well, I can give you a brief overview of this first. So just an overview of how the interactive tool works. When you first log into the tool, everything is run interactively online on the cloud. So it actually uses some baseline kind of middle of the road assumptions, and the entire stress test is run before you even log in. So when you first log in, you will see the results of the stress test right there. The only thing that you really need to do is go over the results, take a look at the inputs, and tweak any inputs that you think need to be a little bit higher, a little bit lower. But they're relatively good default assumptions that are pre-built into the tool. So it's actionable pretty much right out of the box. Another thing that's designed into the tool is the interactivity of it. So a lot of times when you're dealing with a more complex tool or model, you tend to have to plug in hundreds of inputs, run the entire tool, get some large output, either as a file or a printout, and then pour through all those pages. And then if you want to make another run of it, if you want to change one assumption or one input, typically you have to plug them all in again, run the entire model over again, and then have two outputs and start looking back and forth to see what impact that change had on the overall result. Using our tool, every single time you change any input or any assumption, the entire tool recalculates on the fly pretty much instantaneously in the background, which makes working with this tool and kind of dialing in all your inputs and assumptions a lot quicker and more efficient. You can change earnings expectations, you can change loss rates, and immediately toggle back over to from the inputs to the results to see how much impact, if any, that particular assumption change had. So you not only work with the tool more efficiently, but you get quicker, you get to the point where you know which inputs it's really sensitive to and which inputs you really don't have to dig too deep on or think too hard about because they're relatively irrelevant in the results. So on the next couple slides, we're going to walk through these screenshots here. I'm going to give you a very quick idea of the steps in running the tool, and then I'm going to share some of it live on my screen. So the next slide here. So again, first thing we're going to do is customize our inputs. So we present some historical financial data, income statement and balance sheet data on your institution. And then we ask you to give us sort of middle of the road projections for 2 years moving forward. The default assumptions take your current run rate on things like net interest income, fee income, overhead expense, dividend assumptions, and kind of keep them consistent moving forward over the next couple of years. But you can certainly bring those up or down to your liking. On the next slide, we allow you to customize the loan portfolio. Since the entire point here is to estimate losses on the different segments of your loan portfolio, you want to think about any loan balances you have that are not subject to credit risk. If you have any government guaranteed, obviously that was hugely important a couple of years ago with all the short-term PPP loans. But really, any loans that have government guaranteed balances, if you have a sizable portion of SBA loans that are government guaranteed, you'll want to back out any government guaranteed balances so that we can really get a feel for your portfolio that is at risk or at credit risk. The next slide. We have a couple other assumptions here. On the left-hand side, this is where you can plug in an internal capital minimum target for our reverse stress test. So if it's telling you you'd need to have an Armageddon situation in order to get below well-capitalized, but your board has internal triggers, say if you get below 13% total risk-based capital or below 10% tier 1 leverage ratio, that the board has certain steps that they need to take, so you can plug those in there. And then on the right-hand side here, you can also plug in additional capital raises at any point throughout the projection period. This is if you have an interest in iterating the tool, meaning you run the tool, you see under what conditions you might have a capital deficit, and then you can plug in additional capital throughout the structure and throughout the projection period to bring those projected capital levels back up above those minimum levels. So it allows you to kind of get to the end point of doing credit stress testing. And that is really what effect would it have on capital and how can I work this into my strategic planning process and my capital planning process. On the next slide, we have, in addition to financial inputs, we have peer and historical inputs. We ask you to choose a peer group. You can certainly choose your standard UBPR peer group if you'd like to, or you can choose a state-based peer group, which is kind of just a default collection of all the community banks in your state. Or, and we highly advise this, particularly for our stress test, is that our users build a completely custom peer group. For example, if you are, well, our guinea pig today, as we typically use, is a bigger community bank up in the Northeast. If you're a community bank in Maine, you really don't care how bad mortgage losses were in Southern California in 2008. That's really not relevant to the losses that you might see during any reasonable credit cycle moving forward. And so building a intelligent, local, custom peer group, I think is critical to getting good, actionable results particularly for a stress test where we're looking at losses at a very granular segment level. In addition to that, we also allow you to choose, once you choose a peer group, all the peer losses historically will show up in the table below, and you can customize the look back period. So you make sure that the look back period that we're using for the stress period, for the industry stress period, matches the most stressful period for your peer group, right? We had losses started hitting on the West Coast, certainly before they got to the East Coast. And further up the East Coast, it was a little bit later as well. So you might be using 2007, 2008 if you're a California community bank, but not really going beyond 2011. Whereas if you're in Georgia, you might be looking at 2010 through 2012 or 2013, and Virginia or Mid-Atlantic maybe even later. So it depends on where it hit your region the hardest and when. On the next slide, allows you to also customize not only the look back period for your peer group, but also the look back period for your institution, right? When we're running that second test and we're looking at how bad it got for your particular institution during the last credit cycle, you're going to want to pick and choose the time period where you had the highest losses, the highest reserve levels to use for your stress period. In the next slide, I believe we get to the outputs. So again, remember there were 3 steps in the outputs. First step is reprojecting loan losses. So we take those loss rates, those historical loss rates, we apply them to your current portfolio, and we calculate losses that you might anticipate over a 2-year period moving forward. And once we have, an idea of what your reserve level would be, what your net charge-offs would look like, and any OREO losses you might have, we can use that information to completely reproject the income statement. So on the next slide here, step 2 is reproject earnings. Just reminding you that it's not really about the loan losses. It's about what impact that'll have on your income statement and your capital. 2 different institutions that have the exact same loss experience can have a very different path through the next credit cycle, depending upon their ability to absorb losses. First line of defense is what? Your revenues, right? Your ongoing revenue stream. And then your second line of defense is, of course, is your reserve and your capital. So on the next slide, the next slide after this one is where we reproject your income statement. Again, year 1 and year 2, so they're 2-year time horizons under all 3 degrees of stress. The baseline is that healthy if you were to see losses over the next couple of years like you did over the last couple of years. And the adverse, the 2 stress scenarios are the adverse, which is orange, and that's where you're performing worse than most of your community bank brethren did during the last credit cycle. And then the aptly color-coded blood red, severely adverse scenario, which is very much designed to be probably even worse than a worst case scenario, where we assume that you're going to absorb losses worse than 90% plus or minus of your peers did during the worst 2-3 year period that we have on record throughout your entire portfolio, as well as have to get reserves up to an extremely high level and probably absorb some significant losses on the sale of Oreo. But the way we recalculate the earnings, we start with our what we call our core operating earnings, right? Net interest income, which is going to be at least indirectly impacted by the credit environment. Fee income and overhead expense stay relatively flat in these scenarios, but obviously the thing that's going to be completely determined and recalculated in this tool by the loss scenario is your provision for loan losses. And if you think about it, as I alluded to earlier, there's really 2 components to your loan loss provision when you think about this type of scenario analysis. The first is, how much do I need to provide for the actual losses that I expect to see, the loan losses, charge-offs, so that my reserve doesn't drop to a lower level from where it is today? And secondly, how much more provision on top of that am I going to need to add if I need to get my reserve up going forward through this cycle to a higher level than it is at this current point? You add up those 2 different provisions, you get a total loan loss provision expense. You layer in any loss on Oreo, you get a recalculated pre-tax income and net income, and then that's what we use on the final step is the capital impact. Right, we look at your current capital levels, we layer in 2 years worth of earnings or losses and dividends. The global assumption for dividends is that we'll keep a similar dividend payout ratio and that your dividends would be very likely suspended if you were losing money hand over fist in a significant credit cycle. And we use that to reproject 2 years worth of capital levels and ratios. Then finishing with those key questions, where does this leave your capital? What actions might be required or triggered at the board level? And then you can iterate the tool after entering additional capital to see exactly what level you would need and when you would need to inject it in those severely adverse scenarios to get back up to a comfortable or at least regulatorily required level. So let's go ahead and I think that's the last slide. Is that correct, Sean?
Steve, we had a question come in.
Sure.
And actually, it's probably I guess reverse stress test. It's probably a question for you and David because we're going to talk about 2 different types of stress testing. But the question is, do we require net operating income or other current data, or is it built on call report lines and management quote unquote pool level assumption?
Well, I can answer for the portfolio credit stress test. We look at the call report level, call report line items for that. We show you what you've done the last 3 years and what you've done for the trailing 12 months. And then our assumption is for the next 12 months and then the next 12 months after that. So for year 1 and year 2, that, net interest income, fee income, overhead expense stay flat. That is an all right assumption to begin with. However, if you have significant expectations for and have had a history of large increases year over year in your net interest income recently, you may want to project some sort of growth in the net interest income. If you had an aberration in fee income or overhead expense in the most recent 12 months, you kind of want to back out any out of the ordinary or extraordinary results and get back to a sort of a clean middle of the road expectation, but leaving the default values, in most cases is certainly acceptable, because what we're doing here is stressing your current portfolio, right? We're taking what we know about your portfolio as it is today, and then reprojecting losses and reprojecting the impact on what your balance sheet and income statement looks like today. So while you can factor in a little bit of growth, if you factor in too much growth, you're going to be getting in apples. You're going to be kind of doing an apples to oranges type situation, because if you factor in huge amount of loan growth, those new loans are not going to have the same types of loss rates as your seasoned portfolio would historically. And we start getting into a little bit more assumptions and muddy waters, so to speak.
Yeah. And so I thank you, Craig, for clarifying the question. He was really asking more about loan level analysis versus pool level.
Sure.
So David, I'll let you jump in here.
Yeah, I'll just briefly, because we're going to touch on this at the beginning of my segment. But from the loan level, you got to certainly remember that it's non-public data. So we do have to mine, if you will, some non-published data, and that is more loan level. But exactly to your point, because it's interesting you brought up NOI, because we have a few proxies to talk about in terms of how we use assumptions to get at some of those loan level metrics and try to standardize them.
Yeah. Okay. So, all right. So Steve, you're going to do a quick.
Yeah, I forgot. I'll do the reverse stress test when I do. So I'll just go ahead and share my screen now.
Yeah. Let me stop sharing here.
Let's see. Someone else is sharing. All right. Just waiting for you to.
Mine should have stopped.
Oh, now it has. There we go. Yep. Right. So this is, if you were to log into QwickAnalytics and you were a large community bank in Maine, then and pull up your credit stress test, this is what it looks like the second you log in. I haven't added any inputs. I haven't changed any values at all. This is what comes up by default. So it starts by showing you the results. It gets right to an executive summary page showing some of the most critical elements of the entire tool right here, kind of in one snapshot, where we can see all three scenarios side by side. We can see losses ramping up as the scenarios get more punitive, resulting earnings dropping down and becoming significantly negative, and then current and pro forma projected capital ratios in all three scenarios. And then here we just go ahead and chart what those scenarios would look like. And we have a dotted and a dash and a solid line just to visually indicate the regulatory minimums for well capitalized and adequately capitalized. This bank is a large institution. They have not elected for the community bank leverage ratio or CBLR status. So we still have all of their risk-based capital calculations and risk-based assets, risk-weighted assets. If you have elected for CBLR, then obviously we're not going to be focused on total risk-based ratio because that information is not public. We'll be focusing on your tangible common equity and your tier 1 leverage ratio, which we still can get. And so this page will just have a couple less ratios on it if you have elected for CBLR status. So before we go through the outputs here or the results, I'm just gonna walk you through the inputs again really quickly. Do you remember?
Yeah, Steve, just in the same for time purposes, try to move through the slides we covered and as quickly as you can, just to make sure we provide David enough time here.
Certainly. So we start with financial projections, where we can plug in income statement and middle of the road sort of balance sheet projections moving forward. This is where we can customize the loan portfolio, and this is where we can plug in internal capital targets for our reverse stress test and plug in additional capital raise amounts after we have run the tool if we feel like iterating it. On the peer data, first we would choose a peer group. We can stick with the standard UBPR peer group 3 in this particular case. And we can see, for the last 4 quarters, that's a fine baseline sort of scenario. But for a stress scenario, we're defaulting to the year 2009, 10, 11. That looks like kind of the meat of a last downturn. But if you want, you can change the look back period at will. As I drag this blue slider across here, everything is recalculating instantaneously on the fly as I'm doing this in the background. So it's very sort of dynamic and responsive. You can also change how punitive you want the scenarios to become. If you think 75th percentile loss rate is too punitive for an adverse scenario, you can come down here and change it to 60th percentile. If you do that, every single value on this page just changed and was recalculated to be a 60th percentile, or worse than or higher than 60% of the banks in the peer group for each segment and for each time period. If you want to get even more granular and you want to focus and you want to stress your CRE or certain segments of the portfolio more or less than the rest, you can go line by line and change the peer loss rates there. And then the only difference between the adverse and the severely adverse is that in the severely adverse, we're going to use a higher percentile loss rate, like an 80th or 90th percentile loss rate across the board to get some really punitive results. In the bank historical assumptions, this is again where we're going to determine what the look back period was, the last stress period, and when it was worse for your bank individually. And we can change that as well. So you want to dial that in. And then you also can customize the loss rates on your portfolio if the historical experience doesn't get you where you want or doesn't get the analysis where it needs to be. And you can make notes on any assumptions you've made here, and they'll get attached to that segment and through the test and are exported and printed through them. Those are our inputs. If I go to the test results, again, anytime I change an input, I can toggle back over to the results and everything will recalculate immediately. But if you remember, there's 3 steps. Have those loss rates. We're going to apply your peers' loss rates during a healthy environment, during an unhealthy environment, and a worst case scenario environment to your current loan portfolio. So here are your values. Here are the peer loss rates. So we get actual charge-off amounts in all 3 scenarios, obviously getting much worse as the scenarios get more punitive. Also taking into account gain or loss on the sale of Oreo. And finally, that double whammy of having to get your loan loss reserve up to these higher levels where your peers were during the last credit cycle. Once we've done that, we can go ahead and reproject our earnings. So here we are looking at net, core operating earnings. We're layering in our losses that we have to provide for. We're layering in additional provisions to get those reserves up to a higher level, and then recalculating and getting our back to a reprojected income. And then the final step is capital. We're taking your current capital levels and ratios and layering in those earnings or losses and dividends or lack thereof. So those are the steps. Same exact steps for test 2 as in test 1. So we run that the exact same way. And then the reverse stress test, if you remember, this is where we're working backwards, right? We start at the minimum to be well capitalized. The fun thing about that is that there's 4 minimums to be well capitalized if you are if you're not a CBLR institution, right? There's a 5% leverage, 6.5 CET1, 8% tier 1, and 10% total. You have to meet all 4 of them simultaneously to be well capitalized. So we work backwards. We iterate the entire model over and over again at different loss rates until we can figure out what levels of losses you would have to sustain in order to drop below any one of these minimum capital thresholds. And we can determine exactly what those loss levels are. They're obviously very high for this particular institution that has good earnings and high capital levels to start with. That's the reverse stress test. And just a quick word about the management of the tool in general. Once you've got everything plugged in here, you can go ahead and save your inputs as a scenario, give it a name, give it a date, and then you can come back here anytime you want to and access those scenarios on an ongoing basis. There's no limit to how many scenarios that you can save here. When you want to export the results, obviously how much of the nitty gritty that you really feel the need to print off depends upon the implied audience. If this is something you're sharing annually or semi-annually with your board, you're probably just going to want to go ahead and give them an executive summary so their eyes don't glaze over. If this is something that you're sharing with an auditor or an examiner, they're going to want to see all the detail, right? The full report here. You can get it as a PDF with a single click or in an Excel format as well, with all the tables and charts and data and formatting directly in the Excel environment. There's a handy dandy user guide that comes along with the tool, which is great. It's a very visual user guide, kind of PowerPoint style, going through all the inputs and outputs and best practices for running the tool. So I highly suggest, even if you used the tool before, to refresh your memory as to how to get the most out of it. and take a look at the user guide. And then we also have kind of a one-page, very summary level purpose and methodology document that reminds you of what tests we're running and what steps we're taking, and where the guidance is coming from that led to the major assumptions that we built into the tool in the first place. And that's pretty much the whole shebang, Sean.
And to that point, one of the questions is just, is this endorsed by the FDIC? So, typically the FDIC won't endorse anything, but as Steve just pointed out with the methodology, we built this upon guidance from the OCC and the Fed. So we feel pretty confident and have had great reactions from regulators about our tool. They've certainly seen it and certainly, have been, we've had in-depth discussions. But again, it was built upon the guidance that they provided as a way for banks to try to assist them in the data aggregation by utilizing call report information. And so, I think that's really one of the fundamental distinctions is, again, this is a lot easier to aggregate this data. It's not quite as granular, but it's not designed to be. It's designed to provide that capital cushion. And then if you want to get more granular, then you go to the loan level. And that's where David's going to pick up the second part of the conversation. And again, beauty's in the eye of the beholder. It may be what your bank needs or is requested from, but we really are just trying to demonstrate that we can assist you in a number of different ways when it comes to stress testing. So David, if you want to go ahead and take the screen, you can talk a little bit about what we do at IntelliCredit regarding the loan level stress testing.
Absolutely. I was actually on, hopefully you can see the screen.
Yep.
I was on a call with literally within the hour with a bank CEO who said, in some degree of stress, speaking of stress, that we just had to do a classified status, the largest loan our bank has had to deal with in over a decade. And he basically said, what I'm concerned, and of course, depending on the accrual status, that we don't know whether that loan will actually show up in a call report or not, right? And then as a non-performing loan, so to speak. But what we do know is his point was, I really need to make sure we don't have a contagion of this. And how do we go about that? And of course, we do a lot of loan review work, but I said, I think loan level stress testing may get to your concern. One of the things that I wanted to talk about again, and some of this has already come up in some of the questions that we've had in a great way, because as I alluded to a moment ago, we've got some assumptions we'll talk through as far as the FDIC approved. We actually built some of this based on a FDIC white paper that was issued really directed to non-complex banks in terms of what would be adequate to do that. Again, one of the things you have to accept on loan level stress testing is our energy source, unlike QwickAnalytics, is non-public. It's not call report. It's really your own idiosyncratic loan data that comes off of your core system. It's your DNA. One of the things I think you have to accept is that other than when the regulators are looking at you through an examination protocol, no one else sees this, not your peers, not your competitors, not your investors even. Only you see it. You are privy to your non-published individual loan data, and that's the source of the loan level stress test that we have. Now, one of the challenges for this is, and I do remember there was, frankly, a major expansion of stress test sensitivity right after Dodd-Frank. Some of the larger, mega banks were doing that in the 90s and in the early 2000s. But when it became more of a commonplace thing for all banks to be sensitive to stress tests, one of the fallacies of that concept was, frankly, in the early stages, was that in theory, you were having to underwrite your portfolio every quarter, which is totally impractical. So the efficacy of the statistical information, the coding, the ratings, all of that is very important. But I think one of the also challenges with stress test is the theoretical nature of it, right? It's just a what if scenario. But that also conjures up, I think, some of the need to make sure you can kind of head directionally in the right territory, not hold out to be exactly precise. Now, one of the things that we do here, unfortunately, we're not to the level, and we aspire to be at the level of QwickAnalytics where it's, so to speak, a do-it-yourself. But what we now have is quite a functional, and we have not had any, like Sean alluded to a moment ago, we've had no indication from any regulatory oversight that it appeared inadequate or anything. But at this point, the loan level would be done as a service. Again, we're aspiring to make that a tool that could be done totally by bank subscribers. The one little wrinkle that I think IntelliCredit has come up with that I'm not aware of anywhere in the country, and that is we also offer this as a companion to loan review engagement. And the reason we do that is we task our loan reviewers with, in so to speak, real time, recalculating key metrics such as LTVs or debt service coverages to basically differentiate what may have been the data point at original underwriting, or even a data point that was updated through an annual review. So we like to think that gives us a little more of a real-time flavor for that. And I think this is where it would be interesting to talk about what are some of our proxies. This was, again, clearly the gist, I think, of the participant's question a few minutes ago. For example, we use as loan-to-value proxies, or we use loan-to-value as a primary metric, and people will always say things like, well, where are cap rates and where are market trends in this? Well, we kind of have to accept, or we do accept, the fact that we're using loan-to-value as a proxy to represent. Remember, cap rates, I think we all know, are really it's more of an input or a variant of a valuation, right? It has very little to do, if anything, to do with cash flow. It's just a valuation issue. And so we use LTV as a proxy to cover that. As we use as the other primary proxy in this, debt service coverages, which does get to the whole issue, of course, of cash flow. And we like to think that covers items such as interest rates and NOIs, which oftentimes people think of are as requisites for a loan level stress test. The problem with trying to chase interest rates, or in some cases, or NOIs, that really almost begs a far more granular an assessment of your portfolio to be sure that the data is reasonably accurate, reasonably current, and therefore we have opted, we think, and very credibly, to use the LTVs and the debt service coverages as our primary proxies to cover those. The third leg of the stool, of course, is risk grades, and we like to think risk grades are, while maybe not perfect, maybe not exactly accurate, maybe always subject to some trending, is an excellent proxy for both original underwriting and post-booking servicing in a credit portfolio. So those are the primary kind of attributes that we use to be, if you will, proxies for other more minor data, or for the plethora of other data that a lot of people think of when you come to stress testing. Obviously, an overlay now that is very much in the eyes of a lot of the regulators is, okay, what is the econometric profile of the footprints that you're lending into, i.e. the supply and demand aspect. So that's the other kind of half of the walnut that I think you do need to kind of start factoring in, particularly in your what you're doing now with CECL and Q&E factors and so forth. So basically what we, again, like to think of as a good companion to loan review, as an option for loan review, is, again, we think that the currency of looking at loan review, arguably that's the most current real-time perspective of a credit that you're looking at. And if you have a good, robust sample, then you've got the statistical efficacy then to project that into the broader portfolio. Somewhat a way of looking at this is somewhat akin to the way we do sensitivity analysis for credit people at the inception or the original underwriting of a loan, where you're trying to determine, what are the what-if scenarios that would make this loan an approved loan or conditioned approval, or let's modify the terms just to make it more palatable to the bank. But that's a kind of an extension of that from the original underwriting processes. The one thing we've also done that I think is critically important at the loan level stress testing, and you'll see this in the last slide I talk about, is that irrespective of all the theoretical aspect of what every stress test does, right? What if, worst case, that it is really designed to give the bank, so to speak, the top 10 or the primary suspects of specific borrowers that may be indeed at risk under certain stress scenarios, because we see that as the most practical application of a stress test, not just a theoretical impact on capital, because as Steve well said a moment ago, it's really a lot of it's about the individual, a loss from one bank to another may have no real correlation. But to the bank itself, they want to know, okay, what are the loans I now have to treat as my top 10 suspects under a certain stress scenario? And that's exactly what we wanted to combine with some of the theoretical aspect of impact on capital. I will say this, and this again mentions talk about what Steve alluded to. This is not a loss predictor model for us. It is, and based on the FDIC white paper that we kind of built some of this around, it is the impact, the proportionate impact on risk-based capital associated with those various subsets of your loan portfolio. And of course, it's basically a pre-environment and a stressed environment. The methodology we use, and again, we don't have this available in do-it-yourself format, but here I think briefly I'll share the methodology we use. We do allocate a percentage of the bank's current capital amounts to its loan portfolio. Then we assign risk-weighted levels based on FFIEC codes and a pro rata capital amount for those subsets of the loan portfolio at the exposure level. We then select a capital stress test sample for the loan portfolio. We apply the stress. Again, that's often enhanced if we can do that contemporaneous to a loan review engagement, because we then task our reviewers with, as I said earlier, real-time recalculation of those key metrics, things like debt service coverage and LTVs. Here's an example of where this fictitious bank, of course, we were able to calculate that the loan portfolio exposure as a percent of capital was about 65%. And I might add, should have apologized at the beginning. There's construction going on next door with, of all things, a hydraulic, drill going on. So I apologize for the background noise. So the issue here then becomes, step 2 would be to start reallocating on a proportionate basis what that 65% of the total loan portfolio look like on the various categories of your loan portfolio. From that point, then you select the way we prefer to do it. We start with the typical subsets of what you look like. We start looking at what does that cover in terms of exposure. Is it statistically valid enough sample to withstand some scrutiny by even an auditor or accounting lens or a regulatory lens in that regard, or an investor lens if this is being used for any type of credit mark work. Then we come up with the stress test scope, which would be very detailed around, again, having the client bank be able to see exactly what percentage of the subsets of the loans being looked at are being actually stressed, and again, how that next step would be to project those into a impact on the capital. So this would be an example of step 3, where we've come up with that. And then step 4 is basically the applying the stresses. In this particular case, we used 20% stress on LTVs, 20% stress on LTVs, higher LTVs up to 20%, lower debt services coverages by 20%. Again, we can collaborate with the banks on if you want to go to a 25 or 30%, whatever. But again, that would be what we would do. And we would do that simply put by a loan product. In this case, we've just selected, say, multifamily. That would then lead us to some more charts and tables to give us a sense of a pre-stress capital impact and then a post capital impact stress. And then again, the column to the far right shows the beginning of our steps to deliver what loans comprise this stress, at least in a theoretical sense. If we got to that reality of that degree of stress, what would be our current borrowers of the people we really need to put to the front of the line in terms of being concerned about? Again, we pivot back over to QwickAnalytics at certain levels to make sure that is reflective of call report or public data in terms of a comparable sense. So we do add that dimension to our stress test. And this, again, would be the example of, take it down the line. As we all know, the whole nature of regulatory focus now on CRE has almost nothing to do with the 100-300 guidance. In fact, they consider that a red flag. If that's where you're stopped in terms of your bank management or your bank board's defense of wherever you are on the 100 subset of construction, acquisition, development versus the broader CRE of 300%. They want the subset concentrations. They want, where are you on each one of where are those concentrations? And then, as I alluded to a moment ago, not only where are you and how are you defending your significant amount of concentrations, but also where is that being partnered with that kind of almost econometric local perception of the marketplace, of the footprint that you're lending into, and has it got enough demand to take the supply off the table to give banks a legitimate reason to be financing these projects, or a likelihood that they can. I might add that this is also underlying all of this. I keep talking about CRE here. We can do C&I, we can do equipment financing. We've done that in several cases. But CRE, the reason CRE is so incredibly important, particularly for community and smaller regional banks, is and this, so much as you know, is our wheelhouse of our clientele. That's been arguably one of the only segments in the U.S. economy growing their exposure to CRE. Almost every other form of, all the way up to the most sophisticated providers effectively of credit, like the CMBS market or the REIT market or whatever, those people have reduced their exposure in CRE the last several months. Smaller banks have increased it. So it's putting even more onus on our clients, and I think our size clients, to be much more proactive in understanding where they potentially may be in defending all of this CRE growth that's come about. And then finally, I will say that this is the thing we're getting the most kudos over, frankly, or plaudits over, and that is we give the banks not only a list, but also a further qualitative characterization of where the trends of this borrower may be going. And as I said, as you see to the right of that, you'll see that there is not just real estate oriented. We can do it in all sorts of form. We had someone ask us not long ago to do a marine dealer, a marine segment of their portfolio in terms of stressing that. So again, that's kind of in a nutshell what we do. We're hopefully on par to finish development to where we can match Steve's ability to show you a do-it-yourself tool. But at this point, we're just very proud at least to join the credibility of now offering loan level stressing to companion and partner, because I'm a huge advocate of doing both. I think they both tell you a little different story, and I think the general expectation is growing that doing both is really actually a great positive. All right.
David, thank you. We got a couple of questions that came in. Is the loan level info, LTV, and debt service coverage at origination or current? Actual or estimate?
Again, we do all we can to encourage banks to update. That's the good news now, is that seems to be a growing expectation, that any kind of data that's embedded in your core system needs to be updated. If it's just stale, you know, a 4-year-old loan that just had debt service coverage at inception, that's almost meaningless at this point, right? So, and that's the other benefit, I think, Sean, of doing it concurrent with loan review, because we're tasking our reviewers to calculate in so-called real time what was done at origination, calculating that in a more objective way, given where it is, the project is now.
Perfect. The next question was, would debt yield also be an important key assumption for loan level stress testing?
I think that's an excellent point, and I think debt yield is certainly a growing practice and protocol with a lot of banks, and honestly, that's on our list to try to make sure that gets interjected in there. That, as you know, debt yield is really really telling the bank when they can get out of the deal, in effect, or how much they have to deal with in terms of debt versus equity. We know that needs to be incorporated. It isn't quite yet injected into this, but certainly it's a future development point.
Perfect. And then a question came in, can we get a recording of this? So yes, we will send out a link to the recording today and a copy of the slides. I don't know if we'll get it out tomorrow. Hopefully we'll get it out tomorrow afternoon, but if not, then early next week after the holiday. But yes, anybody who registered will get a copy of the slides and the recording. So again, I think as Steve and David have pointed out, right, stress testing, can take shape. What's your priority? Again, I think we want to demonstrate we can help you in a couple of different ways, but we're more than happy to talk to you about what's most appropriate for you, and then determine whether you need to do more beyond a portfolio test. As David indicated, we think stress testing as a companion to your loan review is an excellent option because we're already in there. We've got a lot of the data. It makes perfect sense, particularly given the times that we're in. And then, again, I think we can, work with you just to make sure we're addressing whether the needs are internal or being requested externally to make sure the stress test that you're getting meets all of the objectives that you're looking for. And then just a reminder, right? Any stress test is still going to be seen as a good stress test and should be part of your ongoing process, depending on the level of stress that you might be currently experiencing. Again, the what you need to do and how much you should do might be greater than a bank who's not really tremendously experiencing any stress right now. But again, all that can be part of the fact finding that you can certainly reach out to us and David and the team at IntelliCredit, or myself and Steve would be happy to talk to you about. Just a reminder, and thank you for the comment. As a user of IntelliCredit, there are a lot of things we enjoy, and it's greatly assisted us in analyzing our loan data at a granular level. So certainly appreciate
Thank you very much.
That comment. So again, just a reminder, we're here to help you in whatever form or fashion we can. Obviously, again, whether it's portfolio and call report information or loan level data at IntelliCredit, again, we're just trying to help you get a better grasp of and utilize and capitalize on the data that you have available to you, and hopefully put it into a format that you can be immediately productive with. A couple of upcoming events. We do have some liquidity events webinar coming up in September on the 17th. We also will be back for our coffee talk on the 27th. So certainly look forward to if you need to join us for any of those. Thank you for the comment, Craig. Thanks for your questions today. we'll leave it open here just a few more minutes. If there's any additional questions, let me give it a one last look to make sure I didn't miss anybody. I hopefully did not. David and Steve, any final comments or anything before we let everybody get to their day and a long Labor Day weekend here?
No, I think the bigger issue for me is we're not and being a credit guy, I'm always sensitive not to look like I'm, predicting the sky's falling. I don't think anybody is. We live in a kind of a sawtooth daily environment on whether or not we're going to, have a soft landing or have more stress. But what we do know is not even challengeable now is there's been a different regulatory sensitivity towards credit, and particularly after the failures of the 5 banks last year. And it has put some onus on a lot of the banks to defend their credit processes and further, I think, add stress testing as a normal aspect of their credit risk management.
Agreed. And I think that's really it, right? A lot of this is always about timing. A year ago, we did this webinar and we talked about, why do I stress test when I'm not feeling any stress, right? You flip it around a year, we're seeing some stress, percolating. And to David's point, you don't want to overplay it, but we also recognize that because we've gone through such a benign period of no stress, I think the regulators are sensitive to, not being direct and as forceful maybe as they missed on the liquidity side with those banks last spring. So, I think they're certainly, being a bit more forward with their comments, and that kind of manifests itself in banks being asked to maybe do a little bit more than maybe we've done in the past. Matthew and Oasis, thank you for the kind comments. Appreciate those. Steve, anything before we let them go?
No. Hope everyone has a great holiday weekend, and we stand ready for any other questions that come in. Feel free to reach out directly to us, and we'd be happy to take a look at it with you.
Great. Well, on behalf of David and Steve, thank you so much for taking time out of your day to join us. Again, look for that email that will contain a link to the recording and a copy of the slides. And if we can do anything to be of further assistance, certainly don't hesitate to reach out to us. Thanks so much and have a great day.
Thanks, everybody.